Good morning, everybody, and welcome back to Money in the Law, My FM 101.3, here on Milford's charter station, the local station, My FM. And, of course, we're also joined on the Holliston Hub HCAT with our buddy Tommy Harmon, who is filming us today. And, of course, we're writing something here. Oh, that Tom.
It's a Venn diagram.
Tom's in there. Tom's
Venn diagram.
He's on the list. So
for those of you on the radio, you can't see it.
Tom's name is officially on the board.
But they have a gigantic whiteboard here in the studio, and so we're putting Money in the Law and all the players on. And Tom, if you can't see it, but those of you at home can't see it, Tom is the glue that holds this whole thing together. We're orbiting around Tom here.
Yeah, Tom
right
is.
now.
Yeah, he's kind of the gravitational force.
That's right. That's right.
And of course, the gravitational force of this program, Money and the Law.
Yes.
It is the 12th year running of Money and the Law with your host, Jay Marston. He's from the Marston Law Group and arguably the smartest lawyer anyone has ever met, north, south, east, and west of the Pecos.
Yep.
And I'm John Drouin. I'm just kind of here to help him out and make sure that if he has any money questions or any money, that he can just give both of them to me.
That's fine.
Yeah.
That's fine. We love both. We love both. We love both. How you doing, buddy?
I'm good. I'm good. Yeah.
Good.
Everybody's kind of back to we're in full holiday
Full holiday mode.
Yeah, and I was telling before we started, I almost had my Christmas gear on today. I almost went. I just had my Christmas tie. But I'm thinking, you know what? I can't just make this the Christmas show without telling you.
Without a warning.
Yeah, exactly.
You know how much I love it.
So
I'll be decking the halls.
Next week is the full-blown pre-Christmas show, because that will air on the 23rd.
Yeah,
that will
right
air
there.
on right before Christmas.
So gather around the tree.
This is like the pre-Christmas show. This is like the 12 days of Christmas kind of thing. This is the partridge in a pear tree. It's the first day.
We've done that before. We've done that. We've done the increase with inflation, how much a partridge in a pear tree costs these days compared to how it cost last year, and send that message.
Yeah, well, that's if you're in the partridge market right now.
Yes, that's right.
You're probably not doing as good as you thought.
Well, this is not a good time. I mean, this is a very popular time for partridges and pear trees, both very difficult to find right now.
Especially up here in the Northeast.
Yes, yeah, that's right. So
if you're looking for those,
if you do find them, if you are going to go looking for them, my suggestion is wear an orange vest. Okay, don't go in all camo with your with your partridge collar, whatever your partridge thing there. Whatever you're going to do, you want to make sure you don't get yourself in trouble.
You may be overpaying if you buy it right.
Yes, that's right.
Understand that again. You're buying value, and it's kind of the way it's the market. It's what the market's demanding right now.
Yes.
So partridges, pear trees, turtle doves, all of it is it's up right now. So be careful.
So we moved the Christmas tree a couple of years ago out of the living room because we were kind of we were getting capped out. We probably get 8-foot ceiling, whatever. So you go and you try. I'm standing there in the lot at the Christmas tree lot, and I go measuring with my hand, and I'm like, if I can touch the ceiling, then if we measure wrong, I got to come in, I got to take the whole top 1/3 of the tree off. And
so you have more of like a rectangular.
Everybody
tree.
gets mad. It's a little middle of a boxy feel.
Yeah.
And so we went with the dining room, which is a much larger. It's got kind of a cathedral effect to it. Ooh. And I tell you, wife took full advantage this year.
So
full advantage.
Like one of those tree ladders.
She went big tree. She went big tree this year. Yep.
She called in Mark Aronian to come in and get his
drop
bucket.
it through the skylight.
Yep, there you go.
So that's not coming through the door. Drop it through the skylight. Yep, that's right.
That's good.
So yep. So that's so I get that going on. So.
I do like the big Christmas tree. I'm drawn to it.
Sure.
But like you, we're limited. We have like the the 8.5-foot ceiling, and it's we put it in the same place for the last 20 years. So it's a science.
Yeah,
right?
it's only got one spot. I mean, in most cases, there's only really one spot for it to go. Yeah.
Yeah. So it's a science, and so I've done this enough times where I know what color tree to get, the blue, green. So I'll walk and I'm like, yep, that's the one. And then the guy will be like, hey, do you want me to trim it up? And I'll say, yeah, exactly. This is, and I'll show him. And usually it comes out okay. And then we save the stump. The stumps are. You save those?
No, it's stump. It's a wood stump.
Well,
what am I saving for? What, am I making something out of it?
You may get, there may be a Christmas craft that may come out of it.
All right.
That's it. Waste not, want not, especially at Christmas.
Oh, I tell you, waste not, want not. I would put it up on the 23rd and take it down on the 26th. But
we'll talk.
I get overruled. Here's the other thing that bothers me. As soon as you put it up, and I don't know enough about the science. You mentioned science a minute ago. The minute you put that thing up, I feel like I'm just vacuuming up needles.
Well, that's what happens. Yeah,
I
because
get
the
how it
tree,
works.
the
I get how it
tree
works.
is no longer buried
I
in the
get
ground.
the idea. I get the idea, but it's like, but I say to myself, I can't get a couple of days. Like I'm putting string and lights up on it, and by the time I'm done, like 40% of it's on the ground, and I'm like, what is going on here?
Yeah.
How long was this thing hanging? I find that part a little frustrating.
Cast your mind back to when you put up the Christmas tree and you had a brand new dog that was like, oh wow, I can eat this thing.
my God,
and
it's
when
like
I,
a giant
when I
snack.
grab it and I pull it, all the needles fall
Yeah,
up. Yeah,
sure,
yeah,
along
that's-
with all the tinsel and all
that's-
the other stuff. And,
yeah, that's fun.
And by the way, brand new dog. I mean, nothing says an exciting Christmas like them eating one of those hooks that cover all the thing, and then you get yourself a beautiful Christmas gift of a nice wrapped up bill from the Natick Emergency Animal Hospital for
$1,500. Yeah, it's,
$1,500. What are you talking about? That'll be a gift.
That's
$1,500.
a gift in itself.
Yeah, that'd be a gift. So it's all good. It's all good.
It's all good. All right, so Tommy, what about you? You got your Christmas tree up? You guys all ready to go?
Fake one this year.
Attaboy.
That's all right. You know what?
Nice.
The faker the better. That's not even
Bigger,
green,
the smaller,
is it?
the better.
Yeah.
Like an umbrella. He just pops it up, puts it in.
It says Merry Christmas on it. Yeah, there you go.
Rolling by
Savannah.
in the afternoon of the 25th. You just take it out of the stand. Whoop whoop. Slide it back in the box.
I mean, like when you go down to Key West, is that your attitude down there? Because it's like, are they anti-Christmas down there?
No, actually, funny you should say that.
I can only imagine
I just got back.
Floridians.
I just got back.
Wow.
I was down there for the boat parade. All the boats are all lit up. That was fantastic. The houses are all lit up. The palm trees are all lit up, which does bring a tear to my eye. I know.
mean,
I'm
I know
a
you
different
don't like
person.
Christmas. Yeah.
I'm a different person.
Yeah.
It's a
You're all
different
talk.
feel. It's a
You're
different
all
feel
talk.
down there. There's something about celebrating Christmas in flip flops.
Yeah.
It just changes the whole vibe. The whole vibe. I'm just saying.
Yeah, the palm trees look right. You're like, oh no, that's a Christmas tree right there.
That's exactly. I got
that's
pictures. I'll
what
show you
Christmas
pictures
tree's
later. It
supposed to
looks
look like.
really nice.
Yeah.
Really nice.
Yeah,
Yeah. Nice
so
cold Corona for the boat parade. Flip flops on.
So that's the part I
Happy
don't get. I mean,
Christmas.
you're all Christmas, Charlie Christmas down there. This is Christmas town right here. You're sitting in it. You're living
please.
in it. Yeah.
Whatever, too cold.
It
All right,
is
whatever.
cold.
It is cold.
Christmas is cold. It's the North Pole, not the South Pole.
That's all right. I think they're both cold. But anyway, yeah.
when you put it that way.
Oh, by the way, we have a quick announcement to make before we jump into today's topics.
Jay
We were told to announce the fact that you're
Wait, were we
listening.
told to do this?
We
or
were,
was
we
this-
were instructed. We were instructed.
I mean, I got some-
You're listening to My FM 101.3, broadcasting live from the JBrianDay.com studios.
This is it.
J. Brian Day, your local emergency service experts. Now, before anybody gets into the obvious joke that's just hanging out there about a lawyer reading an ad from an ambulance, I just want to tell you that, usually
No,
we're
you don't even know what. It's not emergency.
What is
It's
it?
not an ambulance.
What is it? That was an ambulance. Not an ambulance? My
It's
bad.
not an ambulance. No.
you sure? Oh,
no.
all
I mean, didn't you ever drive on 495?
I see the big sign, yeah.
What do you think? Does it got like 40 ambulances?
I don't know. It's a big sign. Am I wrong?
No. It's like when your basement floods or like something like your house.
Oh, all
catches
right,
on
then
fire.
that's different.
Yeah,
All right, that's different. Oh, then you still need a lawyer
I
because
like
you got to
it.
sue somebody for all the damage to your house. So
Somebody-
either way,
no matter
either
what.
way, a lawyer is your solution.
No matter what, you call J. Brian Day. The next call you're making is to the Marston Law
Right.
Firm.
Don't call.
That's
Don't call them if you fall off the ladder, cleaning leaves out of your gutter. Don't call them for that.
Yeah.
I thought it just had that vibe.
No, I
It just had
understand.
that vibe.
It's all right. I mean, you only listen to like this.
Sorry, Jay Brian. My bad. My bad. Don't yell at Tom.
We share the same name.
Don't yell at Tom. Don't yell at
J.
Tom.
Marsden
That's
Day.
right. That's right. Let's steal that.
All
So
right.
what's on your mind? What do you want to talk about today?
I want to talk about I want to talk about interest rates. I want to talk
Please.
about like fixed income and kind of the this is like the new surge, this new oh my God, like the interest rates are up. I can get a CD now that's
worth getting.
Yeah, that's worth getting, right? I can buy treasuries. I can buy I can there's these kind of souped up money markets that are actually paying more than like 0.00%, and kind of how we're using those and how clients are like they're excited about it, and some and how, but more importantly how like we position them in the overall portfolio and in the overall way, like kind of the way we look at things, because the way you manage, the way I manage, there's always the prudent people always have an escape hatch, right?
Yep.
There's always a somewhat of a safety net in any kind of portfolio, unless you specifically built it where there's no safety net. And then
Right.
again, as we said, everything's got a purpose. Everything is done, with intent. But for the, for most of what we do, there's always going to be kind of like this chunk of chunk of money that's
Sure.
on the side that is not necessarily that is in a less riskier position than is the remainder of that portfolio.
Okay. All right.
So,
I got you.
so the interest rates and and kind of the rising of the interest rates. We'll talk about kind of some of the effects that has on on the equity market as well, but also how that affects the way we look at the portfolios and some of the different management techniques that we're using now.
Nice. Well,
I mean, it's fascinating.
Well, it is fascinating, but you know what it does? On the law side, it dovetails into this idea of when you've got, when we're drafting trusts for clients and clients want to figure out, how they're going to distribute their money to heirs or how they're going to distribute money to people over time. One of the things that we'll suggest is, well, you can allow your beneficiaries of your trust to have access to income and principal and some, we figure out a formula. But this brings up a great point, for somebody who has a sizable portfolio, and if the goal was that they're only allowed to get income, the changing of the interest rates has fundamentally changed how much money people are getting out of their portfolio, out of a trust that they may have drafted. And now, of course, now they've got more income than they had. And this idea of, don't fall in love with that number because it moves around a little bit. It was not a lot years ago. Now it's gotten better. Where does it go from here, and how do you plan for that?
And especially when you're talking about those situations, is that the trusts are written specifically. So usually there's some very strict investment guidelines that come along with that. So it'll say, hey, you can get income, but this is the maximum amount of equity exposure that you're allowed to have.
Sure, in some cases, yeah.
Or it may say there's no equity exposure. You get whatever the feds are going to give you for an interest rate and go from there. And that's what the trustee has to work with. So yeah, it's all good stuff.
All right, we'll be back. Quick break. We'll be back.
We're going to take a quick
Yeah,
break.
let's do it.
Right now, we're going to take a quick break, even though we don't need it because we're not even tired. But because we're getting closer.
You look tired.
You know what? I'm in recovery
I'm
mode.
just saying. You just said we're not tired. I'm just saying you look a little tired.
I don't look that tired.
Tired.
Don't tired.
See the qualifier you threw in there?
Yeah.
That's it. All right.
All right. You know what? All right. We'll be right back. Don't go away.
A little weathered. And we're back. My FM 101.3. Jay Marsden with the Marsden Law Group. John Drohan, Main Effort Financial.
Yeah.
We are here in the jbryanday.com studios. You know them as the cleanup guys. So if something ever goes wrong, you want to jump in there and
They
get after it.
emergency stuff. There's something happens in your
Broken pipe, call them.
There some sort of nuclear fallout. You
Yeah.
could call Jay Bryan
Sure.
Day, something like that.
Yeah. The tree, you know what? The water from your tree container, because you can't see it, right? You're trying to fill up the water thing, like how much water
That's a
do I put
party.
in the tree thing? And you're just in there,
Yeah.
you're just pouring away, thinking you got plenty of room.
I just
and
bring
then-
the hose in, right? Yeah.
That's a great idea. Wet the whole thing down.
Yep.
That's probably why I'm having that needle
Rinse it.
problem.
Yeah,
That's
yeah.
right. So you're here, Money in the Law,
Rinse
My
that
FM,
tree.
101.3, Jay with the Marsden Law Group, John Drohan, Main Effort Financial. Talking interest rates today, which is exciting because they're high, which is great.
Yeah, so the interest rates have come up, right? So this is, and what we've seen over the last probably about 9 months, or going on a year now, is we've seen a steady increase where the Feds have increased the interest rates. And what that means is by increasing the interest rates, that means that banks are now allowed to, or are now able to give a greater return on money. And that's kind of
For
the bottom
invested
line.
money.
Yep, for invested money. So if I'm in the old days before when the interest rates were
The
low,
old days, yeah.
well, it feels like it now, right?
It
Yeah.
does,
Feels,
it does.
feels like it now if you're going to go because this affects not only the banks but it also affects the lending rate, right?
Yes, it do.
So from a lending standpoint, we're back. When people be like, "Man, I have a 3.5% mortgage. That's too high. I need to refinance that
We
thing."
can refi that 2.8.
Yeah.
I'm just leaving money on the table,
Yeah.
just giving money away.
Yeah, and now I think the average 30-year mortgage rate right now is just over 7%, like in and around
Yeah.
So I can remember refinancing. Remember refinancing to 7% and being like, "Oh my God, that's so good."
What a
and
win.
now like 7% is like everybody's like, "Oh my God, it's the highest interest rate ever."
It's never going to get better. Never.
Yeah, I'm never going to be able to buy a house, and
Yep.
folks. So that's what happens. So when the interest rates go up, all of the rates. So the bank is able to they will lend money and earn a higher interest rate, but at the
Yes, they
same
will.
time, the money that gets deposited, they can give you because they can do that because their ability to lend money, they make more money on that, then they can give you more money on the money that you deposit.
Yeah,
And that's
yeah.
that's kind of that's the nuts and bolts of it. So right now, you can get in the old, back when we were, forever, the interest rates have always been kind of down and not, where you'd say, well, is it worth putting money into a CD? There's always like that CD question.
Well, it was a joke. It was a running joke where you just said, you're not going to leave your money at the bank. They're not giving you anything. It was always pennies on the dollar.
Yeah,
pennies on the dollar.
So like a 1 year CD would be like 2% or 2 points, and you're like, well, do I really want to lock my money up for 2% when I could? And again, remember, not to compare an apple to an orange. A CD is guaranteed. It's guaranteed.
Yeah, let's put aside the risk discussion for 1 second.
So remember that's guaranteed by the banks and the FDIC. So there's no risk involved. There's no financial risk involved with a CD as opposed to if you put it into the market, right? So understand there's a different risk of it. Like risk aside, you'd say, well, if I can assume some risk, why am I going to put my money into a CD that pays 1.9% or 2% versus putting it into something else that has some risk, but I have the ability to earn a little bit more? We're not talking about putting it into the emerging market, ETF.
Right.
We're talking about something that like a fixed income product, but something that is earning a little bit more than just 1 or 2%.
Right.
And the other side of that, the other piece of that is that with the lower interest, when you had the lower interest rate, and people are like, well, I'm really risk averse, and I just want to keep my money in the bank and just keep rolling over these 1.5 or 2% CDs. The risk that we would always say, well, you run the risk. It's the inflation risk, right? So is that interest rate that this consistently low interest rate? Is that low interest rate consistent with keeping up with inflation?
Sure.
And most of the tables and the data will show that a 1 or 2% interest rate isn't going to keep up with inflation over.
Yeah, you're losing money. You tell me you're losing money. If inflation's at 2 and you're getting 1 from the bank and behind 1%, you're just losing money. It's constant principal erosion.
Right, but now we're in a position where now that the interest rates have come up, now things are becoming a little bit things are more attractive.
Yeah.
On this guaranteed interest rate side. And as a manager, as a money manager, or even as just like my own investor, you'll say, look, hey, if I'm going to have money that I'm going to park on the side, if I'm going to have money that I don't want to have, I want to have minimal risk to.
Right.
How cool is that? That I can now, if let's say I have $100,000 that I want to keep I want to have no risk to it, I can put that into a treasury bill. I can put that into a CD that is guaranteed by the taxing power of the or the treasury bill guaranteed by the taxing power of the United States government, and it's going to pay me 5%, and there's relatively no risk in that.
That's real money. That feels like real money.
It feels like real money, as opposed, because in the old days, we would say, look, we want to get a reasonable interest, but if we don't want to have any risk, then we're gonna give up the return on that. We're going to give up getting any return back. But now we have the ability to say, well, hey, look, we're getting a little bit more of a return. We're getting a 5.5% return on some of these things, and that changes kind of the way you look at, especially when you're talking about income generation. When you're talking about kind of long-term, from our portfolio, we want to take 4% per year from this portfolio, and we want it to generate an interest or a dividend income. And now all of a sudden, if I can take some of that equity exposure off the table and replace that with some guaranteed, government treasury bills or with CDs, that makes things a little bit different. And what it does, it reduces the risk of the overall risk of the portfolio.
Well, the theory before was that if you were operating off of that 4% number, right? I can withdraw 4% from the portfolio. And I'm sure you've had this conversation with your clients where people come in and they're not always hip to the idea that 4% number ideally is an income number, right? So this used to happen to us all the time at that small mutual fund company in town. People would roll in and say, the Magellan Fund has averaged, 13% a year over 10 years and blah, blah, blah. And so, of course, I can take 4% out of my account every year. And actually, I can take 10% of my account. That's what they would do,
making
right?
money, yeah.
It's averaging 13. I can still take 10. And then we'd have to go into this discussion around market up, market down. That's an average, blah, blah, blah. So then you have to talk about erosion of
Which is a lot
principal
of blah,
issues.
blah, blah.
There's a lot of blah, blah, blahs in there. But you talk about erosion of principal issues and things like that. Well, now, when the fixed income side of the portfolio is much stronger, your interest rates are better from that perspective, now you're not putting as much pressure on your principal.
Yeah, and that's the whole thing. And we say this all. You say the same thing all the time. Clients are like, hey, when things are going good, like, this is great, market's going good, I'm getting my income and my account's going up, and I'm like, yep, that's great. That's what's happening right now. I go, at the end of the day, my job is to make sure you don't run out of money.
Yeah.
My job is to make sure that you always have income and you always have enough money to be able to make your ends meet and achieve all of your goals.
Live your life, do what
and,
you want to do.
And then
Yep.
at age 110, you still got money in the bank. You still got you still have something. You just don't run out of money. So during when times are great, this is good. That the things feel good. Those aren't the times that I'm concerned about. I'm concerned about the times when things aren't going to be good, when the market is going to fluctuate, when there are going to be situations, or there may be a time when you need more money for a certain situation, whether it an opportunity or whether an emergency or whatever. You need more money, and you're going to have to put some more pressure on your portfolio. So the less pressure I can put on it during the good times.
Oh, yeah.
The better it is for me. The better it is, and not only for me as the manager, but it's also way better for you as the client.
Well, the less pressure you put, that's more money that can go back into the portfolio to provide more horsepower for things down the road, right? I mean, that's everyone's dream scenario is I'm living off my dividends. Well, when your dividends were 1%, you had to have a pile of money to make those dividends, make living off those dividends work. Now, at a 3, 4, 5%, in some cases more, that probability or that possibility becomes more real.
Yeah, we always used to make the joke, when we'd be explaining the portfolio, and we'd say, okay, this income portfolio has about 50% equities or 50% stocks and ETFs kind of stuff, and 50% fixed, like a 50-50 balance.
Sure.
And some savvy client would say, well, why does it have to be 50-50? And you're like, well, a couple reasons. One is because I'm not going to be able to generate the 4% or the whatever I need to generate as an income without that equity exposure because the interest rates are so low.
Right.
Right. I mean,
right.
And so we won't be able to reach that number unless I have because the equities will generate a higher dividend or higher yield. The second thing is that the equity exposure is designed to enable you to be able to have potential growth over time if the market grows, right?
Hedge against inflation.
Because that's right. Because you're make it up. Your $1 million portfolio right now, 20 years from now, if it's still $1 million, it's not worth the same amount of money than it is now. So we need to have a somewhat of a growth component. Again, we're mitigating that risk, but there's got to be that growth component in it. That's part of it. And so we would always make the joke. We'd say, look, you're earning 5%. If make up a company, if Apple decided to issue a 30-year bond that pays 5.5%, then we just buy it and it'd be academic. We wouldn't really have anything to
as
talk
long
about.
as you only need $50,000 a year out of your portfolio.
That's it.
Sure.
Well,
okay. Right.
So that's it. So when you think about it, if I could buy a 30-year treasury, that's going to pay me 5%. That's great, but that doesn't change that doesn't address the inflation issue.
Right.
So, but what it does address is it addresses the equity exposure risk. It addresses the amount of pressure that you put equity-wise on your portfolio, because the less I can do with that, the less pressure I can put on and still be able to generate my income and still have enough to be able to kind of keep up with inflation. That's the golden ticket. That's the golden goose.
Yeah, well, that's the right mix, right? And then that's what gets constantly evaluated and constantly gets tweaked. And over time, rates aren't going to stay at this level forever. There's going to potentially be some sort of normalization. Rates are going to come down a little bit. that 5% CD is going to look real attractive if rates come
Normalization.
down. You know, who knows? Who knows?
Who knows what I mean,
Nobody knows what normal.
That's right. That's right. We were. I mean,
There's a constant series of new normals. That's
Yeah.
what we're talking about, right?
We talked about this before, where you talked to like the old bond guys, right? The old where the guys who would sell the 30-year treasuries that were paying 9%, and they're like, why would I want to buy that? That's silly, right? And now so back then that was normal, right?
Yeah.
That was an 11.5% mortgage rate. Poof, that's a jump on that.
Glad we locked in.
Yeah.
Glad we locked in because your neighbor just locked in at 12 because he
Jump on
didn't. Yep,
that.
that's right. That's right.
That's not
and
a
then
bad
there's a whole generation of people that are like, well, of course money's 2%.
Yeah.
Why who pays 3%
Like
for
all the- right.
You get robbed. You get robbed.
Like think about it, like in the last 5 years or 7 years, like all the homeowners, all of the property owners that we've dealt with, everybody that I can think of, no one has an interest rate that's above 3.5%.
No, you're right. Yeah.
And for all the right reasons, right? And,
Sure.
And again, don't get me wrong. I've been in the industry longer, as have you. We've been in the industry long enough where the mortgage guys, we've mentioned them on the show before. They're like, everything. Yeah, you know what? You could save $100 a month and blah, blah, blah. You might want to refinance. They're always. I mean, that's how they make money.
But
right?
that's how they make money. Is remember when rates were crazy and refinancing was like you were doing it all the
I
time.
refinanced 3 times in 3 years.
With usually the same person, right? Because they had you on speed dial, right? And you would defer to their expertise, and you'd say, hey, let me know. We had a guy, John Holian, greatest guy in the world, friendliest guy in the world. He got me into my first mortgage, and it was like, okay, you're going to do it was an 8-8 mortgage, and there was no PMI. We're doing 2 separate mortgages.
Yeah.
We're doing a
Just
first
to
mortgage,
avoid that PMI.
second mortgage. Let's avoid the PMI, and then what's going to happen is your house is going to go up in value. And then we're going to refinance it. We're going to roll everything together.
That was the plan. That was the play.
And it was like he had 100 of those applications in his bag, and he just show up and like sign here, sign here.
Those guys were printing money.
Oh, they were, and every one of them. This was always funny. Every one of them, sister-in-law, brother-in-law's law firm was closing the mortgage.
Oh, yeah.
Right? So you're like, oh, I didn't know you were John's sister. Oh, well, we didn't really talk about that a lot. But anyway, yes, I am, right? I'm closing the mortgage. So
I wasn't his sister.
that's right. And I'm closing the mortgage, and I'm getting paid for closing the mortgage, and I'm selling you another title insurance policy and another owner's title insurance policy. And it was just
and everybody was happy.
wash, rinse, repeat. That's what was going on, right? And everybody was doing it. Everybody was happy to do it because you were saving money. And then when you got as low as you were going to get, they lose your phone number.
Yeah.
That's it. That's it. That's it.
And that all kind of led up to the 2008. That was right
that's the
up
Big
in
Short, baby.
Yeah,
Yep.
that was right when that was all happening. I can remember, like, right when we first bought our house. I mean, refinance after. I know numbers enough where I'm like, all right, well, I'm doing the math on this, and the one thing that I didn't the first time around that I learned, and this is what I preach to anybody who's like doing when you're buying a mortgage, is when your mortgage person is selling you their mortgage, or the bank, whoever it is, have them sit down and explain it to you in 3rd grade English. Tell me what my closing costs are. Like, explain to me what they are, because that's where, especially back in when it was the Wild West, like pre-2008, you were getting 3-card Monty by these guys like left and right.
Well, because we've talked about this on the show before. This part of these are financial products.
Yep.
Right? They are sold.
I'm selling you this.
And like every product you buy, there's a cost of goods sold, and it's baked into those numbers.
Yep.
And so that's exactly right. There's an origination fee. What am I paying to close the loan, right? Someone's pushing paperwork and no one's doing it out of a charity. And then you get a no points, no closing costs. Oh, great, you think you're getting a deal.
Yeah.
And you look in the paperwork and what are all these numbers? Oh, well, there's some other stuff. And I mean, it was just crazy stuff.
And that was the thing. So I was very fortunate that my mortgage person is my dear friend Kiki Calumet, who is out, and she is out in Chicago and no longer services mortgages in Massachusetts anymore, which is a damn shame, because she was the one who was, and she was successful enough where she didn't need. She was like, look, I do enough mortgages. I don't need to kind of sugarcoat anything.
Sure.
So her whole deal she would get, of all the mortgage people that I would see, like, if I was going to say, hey, you should refinance your mortgage, she would give the best. It would be the best rate.
Sure.
And I would say, okay, two things that you care about when you're doing a mortgage: rate and closing costs. That's it.
Yep.
Not like what your relationship is with the person. None of that. At the end of the day, it's rate and closing costs, and that's what you're evaluating,
Yeah.
right? Because people are like, well, it's with the bank and it's good. No. That bank could sell your mortgage.
Oh, either
you know.
all of them.
Yeah.
Your mortgage is sold before the ink's dry.
Yeah.
It's gone. Yeah.
So the great thing about her is she would say, all right, here's the rate. This is the best rate I can do, and here are the closing costs. And people be like, well, I got this no points, no closing, blah blah. And I'm like, okay, so look at the rate that you're getting for that, and look at the rate that you're getting here, and let's do the math on over time. When are you going to make? So if you're refinancing to call it a 3% mortgage,
Sure.
do you think, chances are you probably aren't going to refinance that again anytime soon?
Ever.
Probably not. And some people were fortunate enough that when things kind of dropped below 3, they could do it. But when you're around in that number, then you're not going to refinance. And even if it's at 4, even if the rate's like we're at 4, if you're going to refinance that number, right, refinance that low a mortgage, there's a reason for you're doing it.
Right.
Whether it be you need the money, whether it be you're moving, whether you're adding, or whatever you're going to do, but there's a reason for it. So right now, that mortgage rate, that's a really good rate, and you're going to, over time, you're going to save money, and you're going to make up that. So it would show how you make up the
You
closing
do the whole
costs.
ROI. Here's where your break even is, all that crazy
Closing
stuff.
costs,
Yeah.
you make it up like within it. But many of these mortgage brokers, no points, no closing, or they'd say, like you said, there'd be like some kind of hidden, well, that's an attorney fee. That's not part of what we're doing. We don't get that money, right?
Right.
And they don't explain how, where everybody's getting paid and how much it's actually costing you to refinance the loan.
All right, quick break. We'll come back. We'll continue our interest rate discussion.
Yeah, so we'll go. Yeah, we'll go back and talk about it, like how the interest rates are they connect to investments, and some of the things, some of the techniques that we're using right now, and we'll also answer any questions that Tom has, because he's like probably.
This could have almost been. This almost could have been marketed as interesting rates discussion. See what I did there?
Interesting. Well done. All right, don't go anywhere. You're listening to Money Law, My FM 101.3. Jay Morrison, John Droy, Tom Harmon. We'll be right back.
Yeah. And we're back, My FM 101.3. Jay Marsden with the Marsden Law Group, John Drohan, Main Effort Financial. Tom's on the bag today, and we are talking interesting rates and talking about how things are kind of rolling along here. And we're also coming to you from the JayBryanDay.com studios. Jay Bryan Day, your local emergency service experts.
That's right.
Not
ambulance.
EMS.
No, not
EMS.
it's not medical emergency.
My bad.
No.
My bad. I hear emergency services. I hear emergency services.
I would refer to.
I go running. I got a lot of chasing to do.
I would say Milford Hospital, which is right down the street. I would go down there. In fact, I've recently had a couple visits.
Yeah. I think you're a frequent flyer over there.
Yeah,
That's
I
right.
don't know if I'm frequent flyer, but I'm definitely But they recognize me.
They know your name. They know
Have I
your
seen
name.
you? Yeah.
You look familiar. So we're talking interest rates. We're talking about how they used to be super low. Now they're super high.
Well, they're not.
Well, compared to where they were, it's super high.
That's
depending
right, super.
Depending on your life experience. Let's call it that. Right?
Depending on your banking experience,
Most folks right now who were saying my first mortgage was 13% have usually paid off their mortgage at this stage of the game, right? Let's put it that way, right?
Well, that's why, right? But think about it, because their first mortgage was probably for like $30,000.
That's a great point.
Right? There was like, but which was plenty of money back then.
Yes,
plenty of money back then. But they were like, I'm paying 13% on the. So when they would go to their financial planner back then, and their financial planner would say, they'd say, yeah, you know what? Should I put a little extra money towards my mortgage? And the financial planner would be like, yes.
Just get rid of that thing.
Yeah, I mean, we're going to invest some money. We're going to save some too. But and again, this is, these are selling product. You could give your money to me, which would make me more money. But in reality, you probably should pay a little extra on that mortgage.
Oh, by the way, I'm going to put it into these mutual funds. They're charging an 8.5% load that you used to be able to charge back in the day, right? So that's in your dating yourself right there. How long you've been in the industry, right? So, but yes, I mean, so pay
it up front.
And the important part about the interest rates is, yes, you're earning more money, you're getting more money on any fixed, for the most part, on any fixed income type investments, but you're also paying more in other areas, right? Your credit cards are probably at 50%. Your
50.
It feels like it, right? Credit cards are 50. Your mortgage, if you, to your point, if you're trying to buy a place, if you're trying to refinance a place, your borrowing costs have gone up precipitously. If you're a business owner, and if you're trying to use a line of credit or things like that, again, borrowing costs for those things have become more expensive, and so it pays to shop around. And this is where it pays, and we've said this on the show 100 times. This is where it pays to have a relationship,
Right.
because you pick somebody up and you say, "Look, what am I looking at?" And they can tell you, "This is the best I can do for you," and hopefully they make it easy.
Yeah, and you bring up a good point about the kind of the ability to borrow money. So that's what when the interest rates are when the Fed raises interest rates, it's to kind of like slow down the inflation piece, right?
Sure.
That's kind of the thought process behind that. So what happens is it's more expensive for businesses and people to borrow money. So
That's right.
So if it's more expensive, then instead of kind of these like kind of we're gonna do these projects and we're gonna be able to borrow money like for pennies on the dollar. Now it's more expensive for them to do that. So it kind of inhibits some of the economic expansion, and then therefore that affects the inflation rate as well. So that was as the rates go up. In theory, the economic theory is that
It slows down the economy.
It's going to slow the economy, and in hopes it's going to slow down some. It's going to inhibit some of that inflation rate that we've been seeing pretty significantly over the last several months.
Well, and then there's a million, the $64,000 question is, what's the Fed going to do at the next meeting? What's the Fed going to do at the next meeting?
Right.
What's the Fed going to do? The consensus is right now, hopefully, that they're probably going to leave rates alone for a while until they kind of see where it's at. Their target rate is 2 to 2.5% for inflation, and they're close. But their concern is that if we don't snuff this thing out right away and get to 2.5, we're going to have a problem. And they don't want it to come rolling back in and say all of a sudden it goes from 3 and they thought it was on its way to 2.5 and it goes to 5. Right? That would throw the whole thing out of kilter. Everybody would lose their mind if that happened. So they're trying to orchestrate what's called a soft landing, where they get the best of both worlds. Right? They don't slow the economy down enough that they create a recession. They're hoping to just bring this thing to a slow halt.
Stop. Yep.
That's right. That's right. And then that way they can say, all right, we did it. We got rates to around, we get inflation to around 2.5%. That's where we wanted it to go. Job growth is strong. People are still spending money. The economy is still growing. That's did we thread the needle? Can we get it done? And that's what they're looking for.
Yeah.
And there's all kinds of conversations going on around, have they already done it? Is there still more work to do? Are they literally going to potentially snuff this thing out by going one more step further? Is that going to be so this really is, trying to hit the dot.
Yeah, and it's it's so complex, and there's so many parts to it, and the whole idea of like there's some industries that it seems like the inflation is still out of control. Like for instance, like the real estate market, like that's
Sure.
like the one thing where they're like, wow, even now, even with the rates going up, the real estate market has picked up. Or is still
hasn't slowed down,
has sustained, right? And that, so there's how does that, and then there's kind of that the income or the gap, like the wealth gap, and how, well, yeah, that's great. So if I slow down if I raise the interest rate, so businesses like wealthy businesses can it costs more for them to borrow money. That's still that kind of trickles down to the to the people who are kind of living paycheck to paycheck, and now the interest rates are even higher, right?
Yeah.
So now and everything is now everything is my credit card rate is higher. It's harder for me to borrow money if I want to purchase a house. Where I was saving up, I was going to be able to buy my first house, and I had enough money to do it, and now I can't afford that because the rate went from 4% to 7.5%.
Oh, and that crushes your monthly number, and then all of a sudden you say to
And I
yourself,
can't afford it.
Yeah, that's right. Even if the house is the same price, right? Just the cost of borrowing
Yep.
has gone through the roof, and it's hard to find a situation where even still house prices are still growing, are still
Yeah,
expanding.
so real estate's a funny. Real estate is like this. That's one piece of it that is. It's going to take a little bit more. There's going to be a little bit more time and a little bit more kind of understanding or a little bit more pressure that needs to get put on it in order for that to quell down. And no one. No one knows the answer to that.
Well,
right?
no,
Not in the short term.
Well, no, and the big brains that do all the analysis will tell you that there's 100 indexes that we look at, right?
Mm-hmm.
And they'll say, well, there's the consumer price index, there's a producer price index, there's the index that has that doesn't include volatile areas like energy services, so forth. So all of a sudden they'll say, well, inflation without gasoline, without oil, is really low. But once we bring those back, and of course, nobody needs gasoline and oil. So once we bring those things back,
everybody's got electric cars now.
Well, they'll do exactly what you said. They'll say, well, if you take out real estate, or you take out, there are things that drive these numbers. And so at one point they were talking about how high inflation was, and that one of the things that was driving the inflation number was used cars.
Yeah.
And who in a million years would say, wait, inflation's at 8% because used cars are going off the tree? Like, nobody would come up with that concept.
Yeah. Who connects that, right?
No, that's
it's
right.
used cars, right?
Yeah.
He's a used car salesman. He's the guy who's driving the inflation rate up.
That's right. That's right. So this is what will happen. So people start to go through and they do these, the analysis on these, and a lot of trend watching, and there's a lot of, where is this going, to get a handle on interest rates. And so you got to build this into your sort of your decision tree.
So you said it. You said it earlier. It's the new normal. So what is the average American freedom fighter like? What do they need to do? How do they need to adapt to be part of this new normal? Well, there's, as we said, if you're borrowing money, it's going to cost you more money it's going to cost you more to borrow.
Well,
money.
where are the three big areas that you're borrowing money? Right, you're going to borrow it for your home. You're going to borrow it for probably an automobile,
for your car,
and then maybe you've got some consumer spending.
And then a fourth one could be if you're going to college, right? If you're for education, right?
Yeah.
So there could be an education borrowing piece as well. So yeah, so if you're borrowing money, it's going to cost you a little bit more to borrow money. Now, when someone comes to us and says, I can't do it. I don't want to, I'm going to pay for my car. Car is a good example. I'm going to pay for my car in cash because I don't want to pay a 5.5% interest rate.
Outlandish.
Yeah. And
un-American.
Yeah. And again, so what you kind of have to do is, us older generation people who sort of kind of remember when the interest rates were much higher than they are now, will say, look, all it is, it's a relative number. It's a relative number.
Sure.
And it's really, I get it. No one wants to pay more than what they have to, or what they would have if things were different. But it is what it is. Like this is the price. This is the price of what it's going to cost you to borrow this money. This is the monthly payment based on a 5% interest rate versus a 3% interest rate.
But the other piece of it is the arbitrage gets better, right? Because before they would give you the car they give you a 0% interest rate, right? Now if that's not in the mix anymore, now you say to yourself, well, they want me to pay a 5% rate on the car, right? But the bank will give you something very comparable. Mm-hmm. On that money that you would dump into the car. What would you rather have? Would you rather have the car with no loan,
Yep.
or would you rather have the cash?
Yeah.
And everyone has a different feeling about that. There's 100 ways to slice that up. What do you want to have?
There's two ways to slice it up. Either you have the car or you have the cash.
You think that's it? Those are the only options?
That's
what if I lease?
There's 100 different. Nobody leases. Yeah.
No, they don't. No, not anymore. No,
Do not lease.
For the most part.
Yeah.
For the most part. But that's the analysis, right? Like, okay, but then it's a fairer fight now, is my point, right?
Yeah.
Before it was always, well, rates are so low it doesn't even matter.
Yep.
Now it's, well, rates are actually, that's a great argument, and you gotta think about it a little bit.
So how a good way to kind of play this is that, again, everything goes back to fundamentals. It goes back to what can I afford. So
Yeah.
if you're buying a house, if you're buying a car, if you're sending your kid to college, if you're whatever you may have to borrow money for, it's what you can afford,
Yep.
right? If you're going to buy
That analysis
something,
is the same.
Yeah. So taking into consideration that the cost of borrowing money, that's just an additional cost. It's a line item number.
Yep.
that has just changed on your balance, on your income statement. So it's going to cost me a little bit more to borrow to buy this car. It's going to cost me more per month. Can I afford it? Can I afford it? And and Jay brought up the point, well, is it worth it for me to put more money towards the car or more money towards the house if I have that available? Is it worth it to me? And so I don't have to pay that higher number.
Right.
And this is where you kind of get in, like Jay said, in kind of that gray area where, I always err on the side of I like to have money, right? Money, because that's why they call it money.
I do
right?
love money. We've talked about this on the show 100 times. Why do people like it?
Because it's money, and because everybody likes, because they call it money.
That's right.
There's no better way or more clear way to explain that than the way we just did. So we all like money, but I like money in the sense that I like to have the liquidity of money in the case that I need said money for something.
Yes,
right?
yeah.
Yep. And something could be whatever I write on this blank piece of paper. I
Yep.
don't know, but if I have money, it doesn't make me happy. Don't get me wrong. Although some people, I guess, if you like counting money or like Rumpelstiltskin and all those guys, then yeah, you like the money itself.
Sure.
But it's not that. It's just what I'm able to do with said money. Now, if the less money I have over here that I have because I put it into my house,
Yeah.
or because I put it into my really fancy car, or because I put it into because I didn't want my kids to have any student loans or anything like
Sure.
that, the less money I have, then that reduces my capability of being able to do things with this money.
Well, having the cash on hand gives you some flexibility, right?
Ah, that's it. Flexibility. Some people
something
have,
you don't
some
have,
people-
something you have completely
something-
abandoned,
something I have,
which is
I'm
your
working on
flexibility.
it.
You don't have the flexibility. That's what you and I are in the same camp on this. I would rather have the car loan and the money in the bank that's my own personal opinion, to pay off the car.
Yeah.
If I had to, that's fine. But if the car people say, fine, here's your loan, you could pay cash, I could, but I'm not going to. Right? And look, paying cash for car, it's a big deal, right? That's a big chunk of dough to throw down. But what we always tell people is saving the amount of money to do those things is hard, right? If you're gonna pay 30 grand for
Where'd
a
it
car,
come from, right? Where'd that-
saving 30 grand for the most part takes a long time, right?
Yeah.
You're chipping away, and to all of a sudden give up all that liquidity, I would much rather say, look, I'll keep the cash, I'll keep the liquidity, and I'd rather write a $300 a month check if that's what it is. I'd rather have the money.
Yeah, and you do, and then you get like kind of these, the loan people, like the mortgage, they'll start talking like, well, this is how much you're going to pay over time. You're going to pay, $1,000, especially for a home loan, like a 30-year home loan, because you pay most of that interest up front. You're going to pay, this is how much you're going to, you're going to pay X amount of dollars, so much more for this property than you would have if you bought it cash. Of course, that's the cost of doing business. That's the cost of enabling you to be able to keep this cash on the side, to be able to have that flexibility. So if an opportunity comes up, if an emergency comes up, or if you just want to, or let's say you want to do a career change, you say, you know what, I'm
Yeah.
gonna do a career change.
Yep.
I'm gonna spend some of this money so I can eat, so I can go back to school, or I can do something where I really want to make this change. This cash enables me to do that. And if I don't have that because I've dumped it all into my house or into my car. Once it's there, I can't get it back.
Well, that's
unless
a
I
great-
sell my car, or unless right?
Yeah, that's a great point. You throw all that money into your house, and then a year later you're like, oh man, I wish I had that 100 grand, right, or whatever the number is, right? Well, I want to go get it. Okay, well, to go get it,
Oh, they'll give it to you.
oh, they'll get it, but now it's going to cost you money. There's going to be origination fees. There's going to be closing fees. There's going to be this. So you're going to have to jump
You're
through
gonna borrow
all those
it.
hoops
Yeah,
together.
you're
right?
gonna borrow
You're going
it
to borrow
back.
back your own money, right? It's going to cost you money to borrow back your own money, and so I'd rather have it and then say, look, you know what? If I wanted to pay whatever it is off tomorrow, I could do it. I have the money to do it, and then let's figure out. I just feel like that's a better.
So the cool thing about this, and this we'll end on this, because this is, you brought up this point. So it's the idea of like, all right, if I know that it's going to cost me X amount of dollars to borrow money for this car, for this house, right? And I know it's more than I would have paid last year.
Yep.
Because the interest rates are up. Okay, I got that. I've kind of I've stomached that. Like,
Yep.
all right, but I can afford it, right?
Yep.
I can afford it. And so, but now the other side of that, so yeah, the interest rates are up, the mortgage rates are up, but on the other side of that is like, look, I was going to put an extra $100,000 to get to that number I would have got last year, but instead, I'm going to keep that $100,000 in somewhere else. I'm
fairly
gonna
decent
I'm going to keep it
earning
in
account.
cash, right?
Yep.
In the old days, before the interest rates, and let's say, yeah, I would have put that into my house, and I feel good about putting money in my house. We'd say, okay, you could put it into, let's say, a brokerage. I'm not knocking a brokerage account because that's what we do, but the brokerage account, in order to get that 5%,
Yeah.
you had to have some equity exposure.
Yeah.
You weren't getting it. You weren't getting a guaranteed 5%
That's
from
right.
anybody, right?
Yep.
So let's say you're like, look, I really want to be safe with this extra $100,000 that I didn't put into my house. Now I can turn around, I can put it into a treasury bill, I can put it into a CD that's going to pay me 5%. And guess what? that's guaranteed. There's no risk involved with that.
That's right. Having cash now gives you the ability to chase down some fixed income options that let that cash work harder for you than it would throwing it at some other thing.
Yeah, if you wanted to keep it in
Yeah,
cash, like
yeah.
if you wanted to
Keep it somewhat
have no
liquid,
risk,
somewhat liquid. Yep,
and
somewhat
it's liquid.
Yes.
You can cash out a CD.
Yep.
You can cash out a T-bill.
Yep.
I mean, you forego the interest, but that's what people like. They're like, oh, well, once it's in that CD, it's locked up. No, it's
Yeah,
not locked
that's
up.
right.
You can get it. You
Well,
just
they see it like the crime of the century. You're like, you want the money? Take the money. Big deal. So it'll cost you a couple of bucks.
You just won't get the interest that you would have earned.
Yeah.
That's all it is. So if someone puts money into a T-bill or a CD, they're like, hey, I need the money because I'm going in business with this. I'm investing in this cigar company or something.
Great idea.
They could take that money and boom.
Jump in.
All right.
We'll
so
give you a rate.
let's hope we learned something today about the interest rates.
Interesting rates, yep.
I mean, more like the
Hashtag-
fascinating rates.
hashtag,
Yeah.
we'll work that all week.
Hashtag that. All right. And thanks for joining us in the J. Bryan Day Emergency Services Studio.com. Yep.
Yeah,
What
love
was
it.
it for, right? I mean, those guys, it looked like J. Bryan Day was over here in the
They were going down the chimney.
They're not
practice,
done.
Little practice run.
They're
Yep.
not done
Yep.
yet. All right. Tommy, thanks for being here today. It's always great to have the Holliston Hub. On behalf of Jay Morrison, I'm John Droin. You've been listening to Money in the Law.
Have a great week and
All right.
weekend.
First day of Christmas.
We'll talk
Partridges,
soon.
pear trees.
See ya.